Matt, um, great having you. Thank you so much for taking the time out. You know, we love talking to you, and more so at such important times, right? So just tell us, what have you made of it, right? When Mark Carney says that this is Canada's path, we choose it openly, confidently, and a path wide open for other countries to join us. When the EU president says that I'm going to be traveling to India for something which a lot of people call as the mother of all trade deals. Is the world learning to live without Donald Trump?
Well, it's a great question, Neeraj. Good morning. And it's an interesting point where we stand geopolitically right now. And while it's really difficult to predict where we're going to be, say, even after Donald Trump's speech at Davos tomorrow, which is another potential volatility event for the overall market, is I've had a lot of conversations with clients today. My main message to them is that this too shall pass. It's helpful and constructive to see other foreign leaders, I think, trying to be a little reticent about the situation and perhaps leveraging it to get other trade deals signed that are also very, very important from a global economic perspective. But when I look at what the potential implications can be, I ask myself, does ratcheting up of further tensions conflict or align with the stated goals of the Republican Party here in the US? It is a midterm year, and I don't think they do. So it says to me that given the focus on affordability, given a lot of domestic priorities that are going to be front and center as we get deeper into a midterm election year, it says to me we're likely going to have some sort of settlement, just like we had settlement after Liberation Day, or should I say a walking back of some of the more extreme rhetoric. And it's just another opportunity for investors to perhaps sit on the sidelines right now, let the dust settle, and then use this as an opportunity to reset your asset allocations and get a chance to invest in some higher quality, higher growth assets that may have been too expensive or prohibitively expensive to get into in the current market environment.
Hi Matt, this is Sharad here. Especially about the Japan market, there has been a concern on the yields front, and of course there is a snap elections also happening on February the 8th. The world is spooked out, especially the treasuries portion. So how do you see this development, and do you see a little bit of pressure coming in the emerging markets because of this?
So I think the weaker dollar should help stabilize pressure that might spread to the rest of the emerging market complex. That said, Japan is a real risk to the overall markets because as longer dated JGB yields continue to move higher, it provides an alternative one to US treasuries. It risks disrupting carry trade and where a lot of other assets are already parked. It just risks further destabilization. And I just think what's happening in Japan has been an underappreciated risk by the broader market. That being said, it's been pretty good for equity investors across Japan, especially those in financial services companies, those in more domestically oriented businesses. So it's not a lose-lose. Again, it just highlights that we need to be cognizant of the risks that are out there, contagion risks, but also that it does lead to opportunities for investors in this environment.
Okay, Matt, good morning. This is Hira on this side. I mean, with all of this that we're talking about, where is, are other countries looking at ignoring the US markets now with what's happening in Japan as well, the kind of impact that could be coming in? If you have to give a summation of all of this and its impact on emerging markets like India, how would you look at it?
So I think first here, the sell America trade, which is I think what you're getting at, I think it's very, very temporary in nature. There's been headlines of Danish pension funds selling some treasuries. I don't mean to be flippant about it, but it's $100 million. It's a drop in the bucket. So at least for now, there is no great alternative to US treasuries with respect to the depth and liquidity of the overall market. But is there a risk of death by 1,000 cuts? Certainly, and I think that's what the Treasury Secretary wants to avoid. I think that's where the legislative branch might start to get involved and hopefully ratcheting down some of these tensions if they continue to escalate. When I look more broadly at the emerging market perspective, I think this opens up the eyes of US investors, especially to realize that this broadening out trade doesn't just mean breadth across sectors in the US, but that there are a lot of good opportunities across international developed and particularly emerging markets. I mean, EMs last year outperformed the S&P 500 by almost 15%. So there's definitely more of a willingness, I sense in my conversations with clients, to look at and consider and actually move money into emerging markets. And I think when you look at a country like India in particular, this is a good episode for investors to remember that India, while it may have underperformed the EM complex last year, earnings growth is picking up. GDP growth is very stable and not that correlated to some of these geopolitical events that we're seeing. And on top of that, it's very decorrelated to US assets as well. So it definitely helps make the case for broader diversification in portfolios, which is why I continue to think it remains attractive. And emerging markets, broadly speaking, also look very, very attractive for inclusion in portfolios.